Richard is 72 years old. He retired 8 years ago after more than 4 decades as a maintenance supervisor at a manufacturing company in Ohio. Every month, his Social Security payment, just over $2,100, covers most of his basic expenses. His mortgage is paid off, but groceries cost more than they used to. Medicare premiums have increased. Utilities aren't getting cheaper. And like millions of retirees, Richard watches every dollar. Then one morning he saw a headline that stopped him cold. Social Security runs out in 2032. Other articles claimed benefits could be cut by more than 20%. Some even suggested the entire system was going bankrupt. Richard immediately started asking himself difficult questions. Would his monthly check disappear? Would Congress stop sending benefits? Should he begin spending his retirement savings more quickly? Or were the headlines painting a much darker picture than the facts actually supported? If you've asked yourself those same questions, you're far from alone. Every year, millions of Americans hear alarming predictions about the Social Security Trust Fund. Yet very few ever read the official Trustees Report behind those headlines. That's exactly what we're going to do today. We'll explain what the trustees actually projected. We'll clarify what trust fund depletion really means. We'll separate facts from assumptions. And we'll answer the question every retiree is asking. What could happen to your Social Security benefits if Congress does nothing? I'm Michael Bennet. Welcome to Retirement Watch. Our mission is to help retirees understand Social Security, Medicare, and other government programs by translating official information into plain English. Everything you'll hear today is based on reports from the Social Security trustees, the Social Security Administration, the Congressional Budget Office, and other nonpartisan sources. Our goal isn't to create fear. It's to replace uncertainty with understanding. Before we begin, if you want clear, fact-based explanations about Social Security, Medicare, retirement taxes, and the government decisions that could affect your retirement income, take a moment to subscribe and turn on notifications. That way, you'll never miss an important update that could help you make better financial decisions. Let's start with the phrase that's causing so much confusion. The Social Security Trust Fund will be depleted in 2032. You've probably heard it on television, online, or from friends, but what does it actually mean? Many people picture the trust fund as one giant bank account that's simply running out of money. That's understandable. The name itself suggests a vault filled with cash waiting to pay future retirees. The reality is more complicated. Social Security is financed primarily through payroll taxes. Every payday, workers contribute part of their earnings, employers contribute an equal amount, and self-employed Americans pay both shares. Those payroll taxes fund today's retirement benefits. For many years, payroll tax revenue exceeded the amount needed to pay monthly benefits. Rather than leaving the surplus in cash, the government invested it in special U.S. Treasury securities held by the Social Security Trust Funds. Those securities earned interest and created reserves that helped strengthen the program's finances. But over time, America's demographics changed. People began living longer. The baby boom generation entered retirement. Birth rates declined. Workforce growth slowed. As a result, fewer workers are supporting each retiree than in previous decades. Imagine a family business where 5 employees once supported one retired owner. Years later, only 3 employees remain, while the number of retirees has doubled. The business still generates income, but maintaining the same level of support becomes much harder. That's similar to the challenge Social Security faces today. The program itself hasn't suddenly failed. The balance between workers paying into the system and beneficiaries receiving payments has gradually shifted. Now, here's an important point that many headlines leave out. The trustees do not say Social Security will stop collecting payroll taxes in 2032. In fact, payroll taxes will continue to be collected every payday across the country. Workers will continue contributing. Employers will continue matching those contributions. Monthly benefits will continue to be funded. So why does the projected depletion date matter? Because once the trust fund reserves are exhausted, Social Security can legally pay benefits only from current incoming revenue unless Congress changes the law. Think about it like an emergency savings account. Imagine a household earning $5,000 every month while spending $5,500. For a while, the family covers the difference with savings. Eventually, those savings run out. Their income doesn't disappear, but spending must now match what they're earning. The trustees describe a similar situation. Payroll tax revenue continues. The reserves eventually do not. Without legislative changes, benefit payments would need to align with available revenue. Notice the phrase, under current law. That wording matters. The trustees are not predicting what Congress will do. They're describing what current law requires if lawmakers make no changes. Those are two very different things. According to the latest Trustees Report, the Old Age and Survivors Insurance Trust Fund is projected to reach reserve depletion around 2032 if current law remains unchanged. After that, continuing payroll tax revenue would still finance most scheduled benefits, just not all of them. Independent analyses estimate that ongoing payroll taxes could cover roughly 3/4 to 4/5 of scheduled benefits. That's why experts discuss potential benefit reductions. Not because Social Security disappears, not because payroll taxes end, but because current revenue alone would no longer fully cover scheduled payments. Let's pause for a moment. We've already established 4 essential facts. First, Social Security is not projected to disappear in 2032. Second, payroll taxes continue after the projected depletion date. Third, monthly benefits continue to be paid. Fourth, under current law, benefits could be reduced if Congress fails to adopt reforms before the trust fund reserves are exhausted. Those 4 statements are all true at the same time. Understanding them changes the entire conversation. So why do so many headlines use the word bankrupt? The trustees never describe Social Security that way. Bankruptcy is a legal process. The trustees discuss projected reserve depletion under current financing rules. Using the word bankrupt creates dramatic headlines, but it also leads many retirees to believe their monthly checks will simply stop. That's not what the official report says. History also gives us important perspective. Congress has faced Social Security financing challenges before. The best-known example came in 1983, when lawmakers approved bipartisan reforms that strengthened the program through payroll tax adjustments, changes to the retirement age, and taxation of benefits for certain higher-income retirees. History doesn't guarantee the same outcome today, but it reminds us that Congress has acted before when Social Security approached a financial deadline. Whether lawmakers act early, wait until the last minute, or choose a different path remains a political decision. The trustees don't answer that question. Their responsibility is simply to explain what current law produces if nothing changes. Now think back to Richard. When he first saw those alarming headlines, he believed Social Security might simply disappear in 2032. Now he understands the issue much more clearly. The real question isn't whether Social Security ends. The real question is whether Congress changes the law before the trust fund reserves are projected to run out. And once you understand that distinction, the conversation shifts dramatically. The next question is no longer whether Social Security survives. It's what options Congress has to keep the program financially sustainable for future generations. Let's answer the next logical question. If the Social Security Trust Fund is projected to reach reserve depletion around 2032, why hasn't Congress already fixed the problem? The answer is surprisingly simple. There isn't one solution. There are several, and every option involves trade-offs. Before we examine those options, it's important to understand one thing. The Trustees Report is not a roadmap. It doesn't recommend specific policies. Its job is simply to project what happens under current law if Congress makes no changes. The decisions themselves belong to lawmakers. Think about a household budget. If your monthly expenses begin exceeding your income, you have several choices. You can earn more, spend less, do a little of both, or rely on savings for a while. Eventually, though, the numbers force a decision. Social Security faces a similar challenge. The debate isn't about whether solutions exist. It's about which combination of solutions Congress is willing to adopt. Let's begin with the option most often discussed: increasing payroll tax revenue. Today, workers and employers each pay Social Security payroll taxes on earnings up to an annual wage limit set by law. Income above that limit generally isn't subject to the Social Security payroll tax. Some policymakers believe raising or even eliminating that wage cap would generate significant additional revenue. Supporters argue that higher earners should contribute more to strengthen the program. Critics respond that higher payroll taxes could discourage investment, hiring, or economic growth. Others point out that if more earnings become taxable, Congress would also need to decide whether those workers should eventually receive higher Social Security benefits. Another option is increasing the payroll tax rate itself. Even relatively small increases, phased in over many years, could generate substantial revenue because millions of Americans contribute every payday. Supporters say gradual adjustments spread the burden over time. Opponents argue they reduce workers' take-home pay while increasing labor costs for employers. A third approach focuses on future benefits instead of taxes. One proposal would gradually increase the full retirement age for younger generations. This wouldn't affect most current retirees. Instead, it would primarily apply to workers many years away from retirement. Supporters argue Americans live longer today than previous generations, making longer working lives more reasonable. Critics point out that increased life expectancy hasn't benefited everyone equally. Someone who spent 40 years in physically demanding work may not be able to remain employed as long as someone with a desk job. Another frequently discussed proposal involves changing the benefit formula. Instead of reducing benefits equally, Congress could slow benefit growth, primarily for higher income retirees, while protecting those with lower lifetime earnings. This approach is often called progressive indexing. Supporters believe it better targets limited resources toward retirees who depend almost entirely on Social Security. Critics argue that workers who contributed more throughout their careers should continue receiving benefits under the traditional formula. Now let's consider another proposal: adjusting the annual cost of living adjustment, better known as the COLA. Each year, Social Security benefits are adjusted to help offset inflation. Some economists suggest using different inflation measures when calculating future COLAs. Even relatively small changes could significantly affect long-term program costs because the adjustments compound year after year. Supporters believe alternative indexes better reflect consumer spending. Critics worry they could gradually reduce retirees' purchasing power, especially during periods of persistent inflation. Notice what's common across all of these proposals. None eliminate Social Security. None suggest ending retirement benefits. They're simply different ways of improving the program's long-term finances. Now, here's another question. Could Congress simply wait until 2032 before acting? Technically, yes. History suggests that's entirely possible. Let's go back to 1983. At that time, Social Security faced an immediate financing challenge. Lawmakers debated solutions for years, but meaningful action occurred only when the financial deadline became impossible to ignore. Many analysts believe Congress could follow a similar pattern this time. Others argue acting sooner would allow smaller, more gradual reforms that workers and retirees could better prepare for. The Trustees Report doesn't predict which path lawmakers will choose. It simply provides the financial outlook that frames the discussion. Now let's return to Richard. When he first heard about 2032, he assumed Congress had already decided to reduce everyone's benefits. Now he understands something very different. The Trustees Report doesn't announce future policy. It identifies a projected financial milestone. What happens after that depends entirely on legislation that is yet to be written. That distinction changes everything. Imagine you're driving across a bridge that's expected to require major repairs several years from now. Engineers warn that without maintenance, future weight restrictions may become necessary. That doesn't mean the bridge closes tomorrow. It means officials have time to strengthen it before problems become unavoidable. The Trustees Report serves a similar purpose. It warns policymakers years in advance. It doesn't dictate the outcome. There's another important point to remember. Social Security doesn't exist in a vacuum. Lawmakers must also consider Medicare, federal spending, economic growth, inflation, labor force participation, immigration, and the national debt. Every one of those factors influences long-term budget decisions. That's one reason Social Security reform has remained politically difficult for decades. Changes affecting one part of the federal budget often have consequences elsewhere. So let's summarize where we are. The projected depletion date is not the end of Social Security. It's the point at which accumulated reserves are projected to be exhausted under current law. Congress has multiple options available. It can increase revenue, adjust future benefits, modify eligibility rules, or combine several reforms into one broader package. History shows lawmakers have addressed similar challenges before, whether they act early or wait until the deadline remains uncertain. But one thing is clear. The debate is about preserving Social Security, not eliminating it. That brings us to the most practical questions. Should today's retirees be worried? Should workers nearing retirement change their financial plans? And what are the most realistic outcomes over the next several years? Those are the questions we'll answer next as we look at the three scenarios most experts consider possible and discuss what retirees can do today to prepare without giving in to unnecessary fear. Now let's turn to the question that matters most. What should retirees and future retirees actually expect over the next several years? The truth is that no one, not the Social Security Administration, not the Congressional Budget Office, and not the trustees themselves knows exactly what Congress will do before the projected 2032 depletion date. What they can do is outline the possibilities based on today's financial outlook and past experience. Three realistic scenarios stand out. The first is widely considered the most likely. Congress reaches an agreement before the trust fund reserves are exhausted. That doesn't mean lawmakers act tomorrow or even next year. But before the projected deadline arrives, they approve reforms designed to strengthen Social Security's finances. History suggests those reforms would probably combine several measures rather than relying on just one. Congress could increase payroll tax revenue, adjust benefits for future retirees, raise the taxable wage cap, modify benefit formulas, or adopt a balanced package of several changes. Many analysts consider this the most probable outcome because Social Security touches nearly every American family. More than 70 million Americans currently receive Social Security benefits, including retired workers, disabled workers, surviving spouses, and dependent children. Allowing automatic benefit reductions would have enormous political and economic consequences. History suggests Congress usually acts before disruptions reach that point. The second scenario is similar to what happened in the early 1980s. Congress waits. Lawmakers continue debating different proposals for several more years. Negotiations become increasingly urgent as the projected depletion date approaches. Finally, with time running short, Congress reaches a bipartisan compromise. This approach would likely preserve most scheduled benefits, but it would leave workers and retirees with less time to prepare for any changes. Uncertainty can make retirement planning more difficult. That's why many economists argue that earlier action generally provides better long-term stability. The third scenario is the one reflected in the Trustees Report under current law. Congress makes no changes before the trust fund reserves are projected to be exhausted. Payroll taxes continue exactly as they do today. Monthly Social Security payments continue. However, because incoming payroll tax revenue alone would not fully cover scheduled benefits, payments would likely be limited to the amount current revenue can support. This is often the scenario behind headlines predicting benefit reductions. It's important to remember that it is not a forecast of congressional inaction. It's simply the outcome required under current law if no reforms are enacted. That distinction is one of the most important ideas in this entire discussion. Let's go back to Richard one final time. When he first saw those frightening headlines, he believed Social Security might simply disappear. Now he understands the real issue. The challenge isn't whether benefits stop overnight. It's whether Congress updates the law before the financial reserves are projected to be depleted. That understanding replaces fear with perspective. So what should someone like Richard do today? First, avoid making major financial decisions based on dramatic headlines. Every year, articles appear claiming Social Security is either collapsing immediately or perfectly secure forever. Neither extreme reflects the careful language used in the official Trustees Report. Whenever possible, rely on primary sources such as the Social Security Administration and the annual Trustees Report rather than rumors or social media posts. Second, create or review your My Social Security account. The Social Security Administration allows you to verify your earnings history, estimate future retirement benefits, and confirm that your reported wages are accurate. Even small reporting errors can affect future benefits. Checking your record periodically is one of the simplest ways to protect your retirement income. Third, continue building retirement income from multiple sources whenever possible. Social Security was never intended to be the only source of retirement income for most Americans. Employer retirement plans, personal savings, pensions, investment accounts, and emergency funds all help strengthen long-term financial security. The more diversified your retirement income becomes, the less dependent you'll be on changes affecting any one program. Fourth, don't assume younger generations will receive nothing. The Trustees Report doesn't make that claim. Instead, it highlights the importance of future reforms. Many economists believe that acting sooner allows Congress to introduce smaller, more gradual adjustments rather than larger changes later. Now, let's step back and look at the bigger picture. The phrase trust fund depletion sounds alarming, but once you understand how Social Security is financed, it becomes much less mysterious. The program is not projected to disappear. Payroll taxes continue. Benefits continue. The real question is whether Congress acts to ensure that future benefits can continue at their currently scheduled levels. That's a financing challenge, not the end of Social Security. Before we finish, let's summarize today's key takeaways. The Social Security Trustees project that the Old Age and Survivors Insurance Trust Fund could reach reserve depletion around 2032 if current law remains unchanged. That does not mean Social Security goes bankrupt. It does not mean payroll taxes stop. And it does not mean monthly benefits suddenly disappear. Instead, it means that without legislative action, ongoing payroll tax revenue would likely cover most, but not all, scheduled benefits. Congress has faced similar challenges before. Lawmakers have multiple policy options available today. Exactly which reforms they choose remains uncertain, but history shows that change is possible. The most important thing retirees can do right now is stay informed. Good retirement decisions are based on facts, not fear. Here at Retirement Watch, we'll continue following every major Social Security development, every new Trustees Report, and every significant proposal coming out of Congress. Our goal is to help you understand what those changes actually mean for your retirement income, without exaggeration and without political spin. If you found today's explanation helpful, consider sharing it with a friend or family member who's worried about the future of Social Security. There's a good chance they've seen the same headlines Richard did. Now they'll understand the story behind them. I'm Michael Bennet. Thank you for watching Retirement Watch, helping seniors understand their benefits. And remember, the future of Social Security won't be decided by headlines. It will be shaped by the decisions Congress makes in the years ahead. Until then, one of the smartest investments you can make is understanding the facts before making decisions about your retirement.